All right, my name's Andrew Falde. Glad to be here. This is the second live interaction with a lot of you. I was on as a guest of AJ's before, and now I get the opportunity to present some ideas for you. So I want to tell you today about the strategy multiplier, and that is how to scale trades that work. So we're really focusing on edges and things that you're already aware of, or have experience with, or have experimented with, and not necessarily coming up with brand new ideas. All right. Because the reality is most traders don't need a new strategy. It's very likely that you already know many things that already work. You just need to recognize and repeat what has already worked. All right. So things that have worked, but you've been off track, or you've lost track of them, or you've forgotten about them, or they had a hard month and you kind of just put it on the shelf. The reality is, if you can be more persistent in what already works, you can gain the benefit from that. So today you'll see how traders are multiplying their results using a simple framework that works with their existing tools. So we're not talking about new software, new tools, new strategies, new indicators. It's really talking about what you already know, because I know this audience is largely experienced. You've invested in yourself, and you've probably invested months or years or decades into trading. And so this is really about extracting more out of what you already know. So first, here's why most traders plateau after they start getting wins. Because you know what it's like at the beginning, you're floundering and fluctuating, and it's ups and downs, and you're making newbie mistakes and all that. But as you start to stack wins, there is still that point where a lot of traders plateau. And that is because we got this weird Zoom thing in the way. Here we go. Great setups become inconsistent results due to missed trades. And missed trades are all three elements of a trade, and that is the entry. So you can miss the fact that an opportunity came. You can know about a type of setup. You can know about an opportunity. You can forecast a certain direction in a stock or an ETF or an index or a cryptocurrency or whatever you're trading. And you can see that coming, or know about it, or have tried it before, but not take the next entry. And so you're simply missing trades. And that will cause you to plateau. If you aren't putting on good trades, you can't have good P&L. So entries, also adjustments. And so those adjustments that come in, if that's rolling a short, if that's closing a spread and reselling it, whatever that adjustment means, taking size off if volatility increases, reducing size and the number of shares you have, many of these different types of adjustments that are skipped, they're missed. That is what causes inconsistent results. And also even more normally, are the exits. And I just know, especially before I really automated almost everything, even to this day, the things I don't automate, I'll often open up the platform and I'll be checking things, and I'll look at a trade and I'll see a ticker symbol, and I'm kind of looking at it and I start to squint and think, what is this again? I'm trying to remember why I put the trade on in the first place. And if I don't know why I put it on in the first place, and I don't have an automated way to adjust it and exit it, there's a very good chance I'm going to miss the predefined or ideal or somewhat optimized exit point, which could be a stop loss or a profit target. Then another reason why great setups, good edge that you know about, can become actually inconsistent results for you is self-sabotage. And that's the too good to be true. So in the middle of, let's say you have a really big winning trade, and then the next setup comes up and you want to put the same trade on, you say, well, that was too easy. Like, well, how could I really get two big trades in a row like that? And so we start to sabotage ourselves, or we have a loss and we say, that was a bigger loss than I really am comfortable with, so I'm going to cut my size. But really that loss is exactly the same size as you studied. It's what you knew was part of the series of trades you should expect. And then you sabotage yourself by cutting your size or switching back to simulation or whatever it is. So self-sabotage can take what you know and deliver inconsistent results, even though it would have generated consistent results. And also limited capacity to scale. And that's both in time and attention. Scaling, often is like another term for compounding or adding size to your trades, but scaling is also like doing more of what works and adding more things that work. And it's very difficult to scale by adding more timeframes, symbols, strategies, reasons to get in and out, opportunities, hedges, all these hard to add things and scale up the number of things you trade if you have limited time and attention. If you have any other responsibilities, even if you are full-time, that you have limited capacity to focus and pay attention and keep track of so many things. And classic is shiny objects. So we can, if you're like me at all, really be drawn to the research, drawn to finding new things and kind of forgetting about those things you already know. So the shiny objects, the grass is always greener, makes you more excited to go tackle something else. So the reality is, you did not come this far to stay stuck. And I do assume and presume that most of you have that months, years, or decades of experience. You've worked a lot. You've invested probably more time, effort, and money than you ever expected you would need to get to the point you are. And you did not come this far to only stay at the level where you are. And getting to the next level may involve something a little different. And that's what we're talking about today. So you already know edges. You've invested, you've learned, you've practiced, you've gone and made those new mistakes, the mistakes of a novice, and you've moved past that, but we still need to get to that next level. So now it's the time to scale the results that you know are possible without scaling the work. Because if you scale the work along with the strategies, we go right back to the previous slide of the reasons why that's so hard and doesn't work. So here's why I know this works, and this is not theory. So I started designing trading algorithms around 2013 is when I was first introduced to it and began my work in creating algorithms, learning very, very basic coding and data management, and coming up with if-then statements and rules and strategies. And looking back now, 12 years from the time of talking about this, more of those strategies continue to work than fail. And that's not a pat on the back for myself to say that I come up with great ideas. The reality is, if you just use good principles and good trading fundamentals in strategy design, and you apply them to the market, and you're not trying to be too cute or too creative, or you're just not ignoring like really obvious things like high slippage cost on 1-minute bars or something like that, as long as you're using good trading fundamentals that you learn over time, that they will continue to work. They may not work the same, but they often work. Not always. Some have failed. Most have not, though. So more continue to work than fail. And on average, more importantly, like, how many, whatever, if you just take them all and say, if I kept all the ones that stopped working and I kept all the ones that did continue to work, the on average out of sample, meaning after the study is complete and go into the future, the unknown future, and how do that those rules and those algorithms work in the future, the results are great. And the main issue, though, is not strategy design. It's not, oh, I found an edge and then the market figured out my edge and so the edge is gone. That's not the issue. The main issue has always been continuous execution, continuous, consistent, unending, not quitting, moving forward, taking the next trade. And to know something works and see strong evidence that it has a chance to work in the future, and then to only do it for the next 2 or 3 trades and then kind of see if you'll remember to do it in the future, is not a good recipe for long-term continued success using those algorithms and those systems. So an example is I designed this strategy in 2015, and this was the 10-year backtest at the time I designed it, and it was an Apple momentum trading system. And then everything after the red line is what happened since then, and that is the 10-year backtest from today. So I have a 10-year backtest originally that was called in sample, and this is the out of sample study forward, and it's nearly a mirror image. And this is one I still trade to this day. It is proprietary. I don't include it in my strategies, and that's not like it's so much better. I just like to have some unique things to myself, so I know I'm not competing for fills with other people. But what I do teach is substantially similar to that strategy in the automated trading collective that's coming up. So another approach, so that approach, let me go back to it, I call a persistent strategy. So it's one set of rules that are involved. This is, I forget the trade size on this, but it's just a sample back test. But it's one set of rules on a specific stock. Everything's just one set of rules, and then it continues on without change or variation. There's no walk forward, there's no optimizations and refitting and all that stuff. This is just continuous, persistent execution of one set of rules over and over again. Another approach that I've developed and kind of been I am implementing now is I call it STAMP, and that means short-term algo management protocol. I use all those cool words because they add up to something I can remember called STAMP. So it's not like they're that special, but the idea short-term is just a period of time, like an event, an opportunity, a forecast, a super overbought stock, a fresh breakout that I think has a potential to follow through for 3 to 6 months. You know, short-term opportunities, not persistent, long-term, multi-decade opportunities. Algo management protocol. So it's how I'm going to use it. So I have the rules. So it's like I'm going to turn the rules on in this circumstance, and I'm going to turn them off, you know, outside of that circumstance. So let's say right now you have a bullish outlook on silver, the silver ETF. And so you're thinking, you know, I think based on AJ's analysis, based on, you know, market factors going on, the economy, et cetera, whatever it is that your thesis comes into, or wherever you discover this potential opportunity, you can have an outlook or a forecast that's not a forever thing. You know, say like, I want to do this forever, but I do want to do it right now. But you want to wait for a better entry point to put on option spreads on silver. You say, I don't necessarily want to do it now, but I do want to be in silver, and I want to use either put credit spreads or call verticals or calls for the upside. So the approach to take, whether it's a stamp system, meaning a short-term deployment of an algorithm, or a persistent one, is to do 3 things. First is to model the opportunity, model the idea, and to find the available edge. And I'm going to walk you through an example, like step-by-step example of how I would take an idea and find the trade that I actually want to do, completely, you know, step-by-step with you here in a second. And then you deploy it. If you're going to do it manually, you introduce all those limitations of how many of those can you really manage on your own. But if you deploy it with automation, now you're actually doing the strategy multiplier. And then part 3 is monitor. So again, if it's manual trades, your monitoring is tedious. If it's automation, it's more of a passive, like security guard type monitoring. You're just sitting there waiting for something to break, not necessarily waiting for every single action that has to be taken manually. So looking at silver, the first thing we're going to do is model it. We want to model what tends to work best. Okay, and part of modeling, the first part really is to observe, make inferences, or take educated guesses. And the more you do this over the years, then the easier it is to jump straight into something that will probably work the first time and then massage it from there. So I didn't put this comment on here. I wanted to add it, but I didn't yet. So I'm going to tell you that something I know about silver. Silver is not a very trendy instrument, or has not been most of the time. It's more of like it explodes and then it just chops around in really messy ranges, and then it can crash, and then it chops around in a really messy range, and then it explodes. So it's a very interesting instrument for that reason. It's unlike, you know, equities, where there could just be like buying systems in place and just institutions just buying, like literally like just placing orders at VWAP for day after day after day after day, and just like driving something like continuously higher, or just waiting for little dips and just always buying, always buying, always buying. Silver does not do that. So maybe it will in the future. It could change, but that's not. I'm just trying to see if I can see it. I don't have it up on my screen right now. So we're going to observe indicators that might give us an edge, an opportunity to run this strategy. We're going to look at days to expiration and option spreads to see which days to expiration might work better. We're going to look, actually, we don't look at a lot of deltas. I realized as I was going through this that we had quite a few examples already, but you would probably want to check your deltas. I go with near the money on SLV because SLV is a very low priced stock and low priced options. So you can't really go out to 20 delta or 10 delta on your short because the prices are too little. You don't get enough premium to be worth any slippage commissions, etc. So deltas on silver, I'm just going to go near the money on those, and then different stops and limits. All right. So I'm going to start with kind of like in the middle. Just say like, I'm just going to pick something in the middle that I think, could work. And I just want to see how it works, but I'm not using anything about trends or momentum or anything about my forecast. I just say what types of put credit spreads on SLV provide the better opportunity. And I can take that information and I can put it into my system to run for me either permanently, persistently, or for a stamp opportunity, like a short-term opportunity to deploy a strategy. So we're going to look on the left. It's not very well laid out, but on the left is the criteria or the parameters of what we're doing. And on the right are the results. Okay. I got a text from AJ, but it's just an alert. Okay, I was like, is he somebody telling me I have to change? Okay, here we go. 30 days expiration, 40 delta on the short, 5 delta on the long. I just want almost all premium. That 5 delta is just in there to just cut off margin use, etc. So it's just something I throw in there. Control risk a little better. 90% stop. My percent stop when talking about a credit spread, just to save room for typing and making the font too small, is it's on the credit received. So if you get a $70 credit, then 90%, of course I picked a hard number, but anyways, 90%, 9 times 7, 63. $63 would be your short, your stop, and $63 would be your profit. So it's per spread. So that over the last, and I think this was 10 years, over 10 years, if you were to persistently do this, you put it on 30 days expiration, you take it off at expiration, and you do it over and over and over again in silver, which remember has some really bad drops and some downside moves. Has a 58% win rate on its own, which kind of correlates to the 40 delta. There's that inverse correlation of the delta is kind of your probability of being in the money, right? So it's pretty close. The reason why I'll take 20 delta trades or 30 delta trades, and my win rate will be lower most of the time than other people who trade the same spread. It's because of the stop loss. So that stop loss keeps my stops and profits balanced. Okay, you can have gap issues that will be more negatively impacted than positively. But those stop losses lower your win rate, but they usually improve your profit factor and also your survivability factor, which isn't usually a number in there because it's kind of a 1 or a 0 thing. You either survive or you die. So keeps you from blowing up. That's the point. Barely profitable on this. So it's 58% win rate, but the losses and the really big downside moves, barely profitable, barely returns on the drawdown. Return on max drawdown is what that means, RIT divided by max drawdown. I don't think I actually repeat that stat on the other slides, but it is just something to look at where I can take these 3 numbers and pretty much infer, like you could almost, if you do enough Monte Carlos and things like that, like if you know your win rate and your profit factor, you have a really good sense of like if you have something worth following through on. You don't have to like get a microscope on the equity curve, and your return on drawdown is going to show you, that's basically worse than just owning the S&P 500. So not very attractive so far. The baseline of this silver options trade, but let's see what else we can do to improve it. So I'm going to add off on the left here, I'm going to add a 50 RSI filter. So a couple of YouTube videos, at least one I put out about this. Price above 50 or RSI being above 50 is one of the better ways, probably the best risk-adjusted way, not the highest probability way, but the best risk-adjusted way to use RSI. But in silver, being a very non-trendy type of instrument, very, very, very choppy, lots of mean reversion and ranging, and then just explosion moves and then crashing. Because of that, it doesn't improve the result, which is pretty rare, very rare actually, especially on credit spreads. So I was surprised to see that actually. So I'm seeing here, like silver is its own market. The silver option market, especially the ETF with low price stocks, is its own thing. You can't do it the same way you would do anywhere else. So we have to model this. So same thing, 10-year run, the win rate drops 4% from 58, was it 50? Yeah, 58 to 54, and it actually goes negative. So we have a profit factor less than 1 means it lost money. Not very much, but it lost money. And that's a comparison to just no indicators at all. So our next test is going to be the 40. So I'm going to take it where instead of, so right here, instead of over 50 RSI, we're going to take it to under 40. Okay. So I'm looking for like a dip. So dips, if you buy on after a sell-off, and you can measure a sell-off however you want, a red bar, a 3-day low, a 5-day low, below a certain moving average, whatever you want to call it. When you buy into a downward pressure, your win rate will go up. Your profit factor may not. Your win-loss ratio and the drawdowns and risk you experience may not correlate to that and improve that, where the win rate's just not worth it. And just like if you buy after it's already started moving up, your win rate will drop below 50%, often to 35 or 40%. But it doesn't mean it's going to be a bad strategy, because your wins could be 3, 5, 6 times as big, where you don't have usually wins that are 3, 5, or 6 times as big on dips that you're using for mean reversion. So in this case, a dip with a credit spread pops the win rate up to 64. So that's 6% higher than no indicator, 6% more win rate. And the profit factor jumps up a decent amount too. So this profit factor, that win rate, is actually starting to turn interesting and attractive. So we'll go to the next thing. So whenever you're testing, studying, running studies, you probably maybe heard this in science class in high school or college, test one variable at a time. Because if you test 2 variables at a time, you don't know what made the impact, or if the combination of them really made the impact, or if one of them made a negative impact and one made a very positive impact. You won't know. So we change one thing at a time. So the next thing I'm changing is the highlighted number over here. I'm doubling the days to expiration. So previously it was 30. So I say, well, since silver options are so cheap, I just kind of come up with an idea and say, let me try to go get more credit. Okay, so more time equals more credit. Well, more time also equals much slower theta. So you have a less theta benefit to this trade, especially near the money options with 2 months to expiration. Then that's going to reduce the theta factor. So, and also fewer trades, etc. So we go to back down to 53% win rate, quite a big jump, barely profitable. And that's just the difference between 30 and 60. So I don't want to go in that direction. So now I'm going to go the opposite. So if going from 30 to 60 was a lot worse, let me go from 30 to 15. Instead of doubling the time, let me cut it in half. So this, again, is it 10? I believe it was a 10-year study. It might have been longer, but it was at least 10 years. 63% win rate, which is 1% less than 30 days expiration, but still good. Like 1% is not significant. And the profit factor is 0.03% less than that. But you do get more turns, more round trips. Also, when I saw the equity curve, the equity curves were less correlated. So my opinion would actually be to put on both trades. So put one tranche at 15, one at 30, and then just manage them separately if I was going with this. So, well, if that was a similar result, let's just go even farther. So I went to 5 days to expiration. Everything else is the same. Below 40 RSI on the daily, same spread, same stop, same profit target, okay? So compared to that kind of baseline that we stuck with, which is 30 days expiration with the RSI dip, it's jumped up to 71%. Now we're seeing a pretty solid trend there in time days to expiration with slower theta, lowers our win rate, while more time to or less time to expiration, higher win rate. So this jumps up 5% all the way into the 70s now on win rate, and then a very, very similar profit factor. So that is up there very nicely. And then I threw one more thing in, because I back out, I go look at a long-term weekly chart of silver, and I look at just how it's unfolded over the years, and I kind of look and see what's going on and say, oh yeah, I just realized something. I'm also putting on put credit spreads when RSI is below 50 in very, very bearish trends and crashes. So I went ahead and threw in the 200-day moving average, and then you can see what happened here. The number of trades really does drop significantly on this, but the stats are really good here. So we have a 75% win rate and a 3 profit factor on that. So just a limited time, I didn't have equity curves. I usually love to look at the equity curves, but I didn't have them today. But like I mentioned earlier, and as you spend more time with it, if you know your win rate and your profit factor, and the time period, 10 years, and you don't have like 30 parameters to curve fit and overfit the past, we just have a few simple parameters like the trade, days expiration, stop limit that are exactly the same. One or two simple indicators, a dip in a bull trend. That's it. Okay, we're not talking like only on Tuesdays after 2 p.m. If it wasn't raining in Washington. When you see, and that's a total joke, obviously, but a terrible one. But anyway, the reason you don't want to see very specific criteria and historic data like that is it's just finding any excuse to have not taken the bad trades. And it's finding little rules that would have kept you out of one bad trade, but kept you in another good trade. And if you do that, it's less reliable in the future. So we go to step 2, which is to deploy. And you really have two choices. When you found an edge, you found an opportunity, and you want to stick with it, you really two choices. And the first is to check the strategy every day on top of all of your other strategies and any other ideas you have, short-term or long-term. And so if it's a daily, sometimes it's more often than daily that you could possibly enter. You're using hourly charts or intraday or price levels. You have to set alerts and be checking that and see what you have to do. And then if the trade is on, you need to monitor continuously to get your stops, because normally like a triggered stop loss in options trades, you can get some pretty bad fills. So you may just want to be watching that and handling it manually. So that means you're monitoring it, or you're just taking bigger slippage risk. So all of that, that's where we come all the way back to the beginning of what we talked about, where the limitations come in. How many of these new ideas? So I just gave you an idea, right? So here's this idea. It's not my favorite idea in the world, but it's interesting, right? I was taking something that's been talked about at Stickytrades, silver, having upside potential, and say, well, what can we do with this? How can we model it? How can we turn it into something that we're multiplying the number of things we can do? Every time we have an idea, we don't have to drop another idea or dilute our time further. What else can we do? So problems with this: limited time equals limited number of strategies. The default scenario in any manual trading is to not take the trade, the default scenario, because to take a trade, you have to be there, decide to do it, put your hands on your machine or your device, and actually do the trade. And that includes your adjustments and your stop losses too. So the default scenario is that you will not do the thing you learned about when you do it manually. It doesn't mean you're not going to do it. It just means the default is you have to overcome the default every single time something needs to happen. And you must re-decide and recommit every single time to that original thesis and the study and the stats that you saw for the different situations and scenarios where you would actually put the trade on. And just because you looked at silver and it looks really good today, but those criteria are not true, you have to decide to stick with your rules every single time. Okay. But if you don't do that and you switch for the other option, which is to multiply your capability with automation, then that stuff becomes automatic. So the strategy multiplier really is this 3-part framework that turns your best individual trades. So when I say individual, it's like I saw this setup and I took this trade and it was really great. Let me go find another setup. Well, you can just define that setup and let it continue. And that's why in bold underline here is the key. What is being delivered to you when you do this is that you go from an individual trader where you're finding each individual trade. Even if you have a recurring system for getting into trades, you have to personally visit and do each individual trade. You turn that into your one action is to set up a recurring series of trades that do what you want to have happen, okay? While taking less of your time, not multiplying the amount of time. And that's where we really have the multiplying effect, right? So we are multiplying the number of assets, strategies, timeframes that you can be in. That's why it's called the multiplier. So right now, if you feel like, hey, when I open up my platform, Thinkorswim, Schwab, whatever, wherever you are when you trade, You open that up and you see, and you're scrolling past, or you're looking up and down at like 10 or 15 or 20 positions. Maybe some of you have 30, 40, 50 positions. Maybe some of you are just like 10 is too many. I just want 5. Or like me years ago, I said, I want my 1 SPX trade and that's it. And so like whatever your number is, whatever that number is right now for you that you efficiently and effectively can manage, then you can probably multiply that by 5 or 10 to get to the number of positions you could automate and still have a very solid sense of what's going on. And the reality is why that matters is the more uncorrelated trades that you have equals a smoother long-term result. That is a proven fact. I don't care if you are a very specific like hedge fund prop firm trader who's scalping. The reality is when you have a team of people who are all doing a scalping and looking at trades a certain way, the firm's overall returns are normally smoother and more consistent in the long term than any individual trader, even the very best one. So that's even the most purely discretionary active trader compared to a team of good active traders. The best one does not beat the risk-adjusted returns of the group. And the same thing is for you with systems. The more uncorrelated trades you can do, the smoother your long-term results. But if you're doing them manually, you're very limited in that. So the old way, which I call friction, which is like the more you do, the more you have, the more friction you have, leads to missed trades, hesitation, because that's that default where you have the default is no trade. So hesitate, just waiting, trying to second guess or rethink what you're doing, or having to remember to go and do it. You must recommit to the rules on each trade. More trades equals more screen time. And ultimately, that is all related to decision fatigue, deciding whether or not to check your positions, deciding whether or not to take the next trade or stop, etc. Versus the new way, which leads to consistency, and that's every setup, adjustment, and exit is executed automatically. And that is with, I would love to say it's 100% reliable. That's not true, but I'll say that me as a human versus the machine beats me, 49 out of 50 times. So that's way more consistent than I can be. It's persistent. So the default is to take the next trade as described and prescribed. So the default situation is to get what you wanted originally, not have to then go and choose to do it every single time. Instead of having to recommit to your rules each and every time, interference to not follow your rules actually requires the extra effort. So manual trading is no effort in order to not do the system. In this, where it's automated, you have to put effort in to actually interfere, which is fine. I interfere quite often, and that's something I'm going to tell you about in a little bit, that you are not setting up a black box and hoping for the best. This is really, you can be involved in the process, and as you should be. And then instead of more trades equals more time and effort, it's more trades with less screen time. And instead of decision fatigue, you become that semi-passive manager, kind of like I said earlier, where you start to feel like a security guard, where it's like everything's running, everything's working, or it's like you think about like a factory where the machines are working like crazy 24 hours a day, and the people running the machines, they're all working hard and they're packing stuff, and you got the truck drivers and all that. And then, who's the guy that happens to get paid the most? He's the guy upstairs in the air-conditioned office with a window, just making sure it's all working, right? So you get to move into that position, which is much more sustainable. So what if you could build and run strategy like this without coding? Because I assume some of you are thinking, well, this sounds super, super complicated. What is it? It's like, it's complex, but it's not complicated. I don't know if it's the term. It's simple, but it's not easy. I don't know. It's one of those things. But it's not as hard as you may be thinking it is. So it is now easier than ever to implement this with visual tools. Visual tools means point and click. So if you can fill out an IRS form, or because it's that time of year, everyone's thinking about that. You go through and you're like, drop down, which of these is what you want? Drop down, select this, fill in this, put the number you want, add the symbol you want. If you can do that, point and click, fill out a form, then you can automate trades, whether it's stocks or options. So the hard part isn't the tools. The hard part is no longer learning the tools. I'm reading right now the Jim Simons biography, um, and where, you know, I forget, it's the man who solved the market or something like that. And it's just interesting to see in all the studies I've done on him. He's one of the most successful, maybe the most successful as far as total dollars and returns, percent returns, as far as purely systems trading and automation, 66% per year for decades. That it was interesting to see how, I mean, he was like starting on a chalkboard doing math formulas and then, like, you know, having to hard code massive computers back when this was like a brand new situation. Like now you can like use your phone and log in and update your rules. So it's very, very powerful that you can do these things now. So the hard part isn't the technology or the systems or learning coding or anything like that. The hard part is knowing what logic to use. And that's where ATC comes in, and what I'm excited to be telling you about and us getting ready for here at Stickytrades. So ATC is the Automated Trading Collective. And what we can automate together in the Automated Trading Collective is equities trades, so stocks, ETFs, ETNs, so options, index or equity options, futures, and more. So you can get into currencies and cryptocurrencies as well. We're not going to talk too much about that. We're really focusing on the first three, but it does translate into additional asset classes. And you can automate your best ideas, whether they be short-term opportunities, where instead of you say, hey, I think this might happen over time, let me put a trade on, and then that will trigger me to continually monitor that opportunity and see what else I can do with it. Well, instead, you can say, I think this is the outlook or the forecast for this asset. Let me run this series of trades. And you say, I only want to run it if the stock's below this price, then continue to run that until it's at this price and then turn it off. Or I want to run this, you know, every single time this happens for the foreseeable future, you know, or say I want to set a time limit. In 6 months, I want it to stop. You can set that up, or these persistent ideas that you want to be in. You don't have to bring your ideas. I am giving you pre-built strategies and ways to pull up assets that they can work on, that you can start with. And these are ones, including the one I showed you earlier. Very simply, the results are almost identical. And that is these pre-built strategies that I originally found 5, 10, or more years ago that continue to work more often than not in a very similar way long into the future. It's very powerful, very good stuff. And that's through a lot of, we've had cycles, okay? We've had crashes and bear markets and all sorts of stuff, and it's navigated very well. You can automate hedges for your manual approach. So let's say you have a bearish outlook on a stock, and you have a big, so I know like a lot of the, like if you're in the, I think it's the super spreads, you could be doing these super long dated diagonals. Hold on a second. So you can have like this, you know, kind of this big overarching structure of, I got my long put, I'm selling puts against it, I'm adding that income, I'm lowering my basis, et cetera, et cetera. But you're like, the overall idea is that I think this stock's going to chop around. It may go up for a little while longer, but then eventually it's going to come crashing down, and I want to be in that. Well, you can automate stock or options trades with all of its own risk controls and parameters in place to only trade bullish against that. There's a video on YouTube. I think it's the last one I did. So today, if you're watching the recording, is March 25th, 2025. The last video on YouTube that I did before this date shows this. If it's not the last one, it's the one before that, where I forget, was it Tesla? I can't remember. But I'm showing an options trade that was bearish and struggled, but ultimately ended up slightly profitable. And then I showed how it would have been down a ton, but you ultimately got it back. So it's like you're right, and you made some money, but it was kind of a stressful ride. And if you run this bullish trading system, short-term trading system at the same time, it catches these massive wins, gets out, lets the stock drop, and so you make money in both. Very, very powerful. Unbelievable. And this is the kind of stuff that I could never do manually, to like hold those two ideas in my mind to say like, here's my big options trade, and I'm going to do all these short-term option stock trades on the hourly chart, and then keep managing the options trade, and then do that in 20 different markets. Like I couldn't do that. So it's so powerful to be able to add that in to smooth things out for yourself. Talk about uncorrelated, like the exact opposite approach on the same stock, but it profits when the other one's down a little bit. They both end up profitable a month later. It's fantastic. So, and hedges for your man, is that what I just said? Yes. Okay, I don't have to read that twice. Active income against your core position. So this isn't like necessarily a hedge where you're really expecting to make a lot. But let's say you own the S&P 500, or you own, 5 or 10 stocks that you really like. You can go out there and sell call credit spreads and actively manage them. It's always annoying when you own a stock and you sell a call or a call credit spread against it, and it just like takes off, and you just realize how much you got hit. You're like, man, if I had rolled that a little sooner or whatever. So really actively managing that and having rules in place that say, man, if it goes in the money, I want to roll it up and out. Like let's take care of this. We can automate that. And almost any indicator or time frame that you can think of, or combine multiple indicators, can either be directly and easily done in the point and click way, or we can customize it with a third-party tool, a couple lines of code, put them together, and take just about any idea you have and automate it. So ATC, Automated Trading Collective, works two ways. Okay, there's a course. The course is always going to be required, or else we can't speak the same language. If anyone, like some people here might have been with me in other capacities and have purchased other training in the past from me directly, we can talk about whether or not you need to buy the course. But we do need to be speaking the same language. You need to have the same basics, or else we're going to be spending all of our time going over the same thing every single time that people can get in a pre-recorded way. And then the mentoring is optional for either never get it, or get it for a little while, or stick around for a long time. So those two breakdowns, and we're going to be sending out pretty soon. We're very close to sending this out. But the two breakdowns are like this, that the course includes automated trading fast start. So that's like, I take your hand, like imagine you're in a crowded, subway tunnel or something, and you don't know which way to go. If I could just grab your wrist and just take you the right direction and get you where you want to go, that's kind of the idea here. It's not exhaustive. It's not a bunch of theory. It's like, click here, put your chart here, copy this, paste it here, add this, link these two things, run your test, see the result. Like very, very fast start. Starting point strategies, these are ones, many of them I've used for over 10 years successfully. And so I give them to you, copy, paste, you're ready to go. Symbol selection, I'm going to put my mouse because I know it's kind of small. Symbol selection for systems. So it's how to pick the right symbols for those strategies, make sure they work, look good. Things to avoid, like low price, low liquidity, how to get those lists together. Some psychology shifts. So the winning mindset of automated trading, like some of these, like we're transitioning from one way of thinking and acting about the markets to another, but you don't need to like give up on the old one. You can hold them both in your mind. Like you can forecast, you can have opinions, but you become systematic at the same time. So we talk through that. Optimization best practices, avoiding overfitting. I'm not a massive, I used to spend too much time optimizing, but the reality is optimizing does not take a long time. You just, what you're fitting the information to, really you're just trying to break it. And if you have a difficult time breaking it, then you probably have something worth starting live at a small size. Routine checklists. So just how in 5 minutes a day you can be running this whole thing for the long term. Then that's where the course ends. And then when we work together in mentoring is where all this other stuff unlocks. I won't read it. You'll get a copy of it. You can see it here, but we go into all sorts of other stuff. But I did highlight one thing with a little red arrow, and that's these advanced strategies, including automated options. I do talk about options automation a little in the basic course. I put you in the right direction. I tell you how to do it. But when it comes to these, because options introduce so many more variables, that we have to talk through a lot of things. And there's a lot of things that it took me a while to learn, like, oh man, I should have always had this in there to, prevent this from happening. Like minimum credit prices, because like random trades happen 0 days to expiration at 3 p.m. And then I was like, why am I putting on credit spreads for 14 cents? So it's like, whatever. I made $12. That's fun, but probably not worth the slippage risk and all that. So stuff like that. Lots of fun stuff. I've been doing this on and off for 10 years now, running groups and training, and we have a lot of fun. We come up with a lot of ideas. My favorite part is many of you are going to introduce new ideas that I've never thought of or have time to study, and I'm going to benefit too. So it's mutually beneficial, and we're going to have a great time coming up with stuff. So I want to share a couple like surprising benefits and observations. This is one of those, it's like lists of good questions to ask people thing that I've seen before. It's like you're trying to really understand somebody. It's like, what surprised you about? That was one of the questions. So it's like looking back on it, like as I went through the experience of doing all these things and implementing all this in the real world, what has surprised me? And I think if it's something that I recognize surprised me or surprised me, you know, as a benefit or just an observation, then it could be very informative to you to see if this is like something you're interested as well. So surprising benefits is like ideas that I spent 3-4 hours on one day to just like, I wonder if this works. And I just kind of, or I watch a YouTube video and somebody says, hey, I like this indicator. I'm like, okay. So I go pull it up and I do a study, and like 3 hours later, I like have a pretty exhaustive study and backtest and systems and everything ready to go. And that months and years later, after I discovered this idea, I did not come up with it. I did not invent it. I just found it from somebody else. I modeled it and I deployed it. Months and years later, that it's paying me, that I'm getting paid, it's making money. That I can't even remember where I found it. I don't remember. I don't know how I would have found it otherwise. And it's just like surprising and fun to just think like, if I didn't automate it, I wouldn't remember that I watched that YouTube video or heard that, watched that webinar or whatever, came across that article, whatever it is. But that I can model it, systemize it, automate it, put it in and deploy it. And I just go look and be like, oh, what's this? I don't even know what that ticker is. I have to literally look up tickers again that I'm trading because I can't remember what they are. Because it was 4 years ago I figured it out. That was probably something worth trading. And I'm like, wow, that's up a lot today. What's that? I didn't have to do it. Very, very rewarding, very interesting. Stop losses are less irritating. So that was kind of like a surprising benefit I didn't expect. Like stop losses always drain you a little. At least they did me and do me. Like when I take them manually, like it's like, you know, it's like just pulls you down a little bit, like puts you in a bad mood. And like, and it's really, and if you do it a lot in one day or 1 week, I mean, that can slow you down. It can derail you. But like they're not irritating. Like trades get taken off and I look and I'm just happy to see one less red number on the screen. You know, if it takes it off, great. I'm like, okay, good. I didn't have to do it. I didn't have to like take that personally. Like it's really nice. I'm able to focus on other things, family health, research, finding new ideas. You know, I can go, you know, if I have a slow morning or the kids are like spring break for us, so the kids are home, and be like, I still want to go to the gym. I can go to the gym and not be back and ready and sitting at my computer by 9:30 Eastern, and I'm not worried about it. I literally can be driving back from the gym or at the gym, and 9:35 rolls around and my watch starts buzzing and I see trades going on that are happening for me that I designed and I want done. Surprising observation is simple ideas. Pretty anecdotal. I can't like prove this, but what I've noticed, simpler ideas have worked longer than very complex ones. And I mentioned that earlier, that if you have to add so many things to force it to work, there's a very good chance you were just like just trying to come up with any like logical rule in hindsight to skip bad things. And that's not going to be the same setup exactly to skip the bad thing in the future. But if you can find a simple way to skip bad things, like 200-day moving averages for not being long, stuff like that. If you are going to be long below the 200, I mean, it better be very opportunistic and have different risk controls. But you know, you are opening yourself up to downside, a little rabbit trail. Automated reporting and logs save time. You know, like, you know, if you manually trade, it's a little harder to go back through, or you have to buy third-party software, or you have to manually document these things to really like figure out like which of these trades made my profit, which ideas are working, which stocks are working, and like pulling those out Did I reduce my basis enough? You know, like all of these different things that are a little harder, a lot harder manually. When you're automating and the software is automating, it's collecting that data for you because it knows the rules. It's categorized it. This is this strategy on this stock. All those trades are grouped together under that category, and all that information's there, so you can quickly see what's working and what's not. Very good one that I did not expect, a surprise, is that automating improved my discretion in forecasting. So discretion in forecasting improved a lot over this time because automation at first felt like training wheels. It felt like I wasn't really good at riding a bike, so I need to use systems and automation. So I like put training wheels on. But over time, like your training wheels, you're getting those reps in and you're actually getting better at it. Where I realized like I don't need the training wheels, but I do like having the stability of automation. So imagine if each good trade idea you had from today forward or you have right now could manage itself from this day forward. The question is, what other edges would you add to your account? So a menu of possible edges you could add if you're not already doing these things. It would be fast growing stocks. So that's when you trade fast growing stocks on momentum or trend. Momentum and trend does not work in a lot of areas, or at least the returns are so low, it's not worth it. But if you capture high beta, very, very fast moving stocks or stocks with a lot of upside, so maybe like a stock that's down a lot and could multiply, like go up like 400% to get back to the old high. In these systems where you can automate them, you can capture most of the upside, maybe not all of it, but you get a lot less downside. So most of the upside and very little of the downside from those. Options, income, and hedges that you're not doing now that you could add. Long options trades, portfolio of ETFs with target volatility. So that's something that can be actively managed on a daily or weekly or monthly basis. One that I'm actually going to be looking at getting into, and in the community, what I would like to explore with traders who get into this with me is time of day and day of week tendencies. So there's, like, I've heard turnaround Tuesday and things like that. Like, so just looking for like the tendencies of price to contract versus expand, and taking different trades based on that, or filtering out trades based on that. Earnings trades management, pairs trading, statistical arbitrage, et cetera, et cetera. Okay. So there's so many things you could add that you say like all of these are great, but again, if you had to do them manually, you might bounce around between them. But it would be very difficult to actually begin to stack them up, which is the title of our presentation, multiplying. Can you multiply the number of things you do and the opportunities you have so your results are ultimately smoother and more consistent, so you can compound your account more reliably? So Automated Trading Collective, I don't know why Accelerator, it's an old program I had. Automated Trading Collective should be available 5 to 10 days. It would have been, I think, available this week, but I think it's spring break or some reason the team, the developers on the back end are out this week. So I think that those last finishing touches just couldn't quite get done this week, but they should be done next week is the plan. AJ, interrupt, correct me if you'd like. I say AJ, I think it's Anthony on there. It might be not. So what you need to know for now while you wait, the pricing at the launch, when we first make it available, is going to be greatly reduced for a limited time to give legacy stickytrades.com followers a great deal. So everyone who is active with stickytrades.com or just on the list, you're here right now, you're going to get the best deal that will ever be given on this program. And for the mentorship, membership, your price is locked in for life. So if you see like the price is going up, that does not mean your next bill will go up. You are locked in for life with no price increases ever for you. And the course will continually be updated. So as questions come in, clarifications come in, new software comes in, updates come, all of that will be done. So there's not going to be some day in the future be like ATC 2.0, and then you have to buy that one too. So if there's an ATC 2.0, you get it. You will have that forever. All right. So how to prepare since we have a few extra days before you can hop in, I would suggest to you to write out sets of rules you are interested in testing and potentially trading live with automation. So like ideas, observations, concepts. I do see a lot of chats and questions coming in. I'll be to those in just a second, especially ideas. Especially, I'm going to be very emphatic about this one, especially ideas that are contrary to your normal approach. If you're doing something that's already working manually, we could automate it to free up your time so you can go do some other things. But it could be that the very next thing, or actually the first thing you want to do, is to start offsetting what you do with something else. So if you tend to trade very bearish most of the time, or you just are very bearish right now, that we could automate some bullish stuff that I can show you has not lost any money in this downturn, has done just fine, and knows how to go flat and stay flat during a decline. And then your bearish trades can make money and they'll be out of the way. And then when the market turns and goes back up, if you weren't able to navigate that, that'll catch you and cover the upside. And also watch your email because it's coming and you'll get that discounted price very shortly. So let's get into questions.
Hey, Andrew, this is Nod.
Yes, sir.
Great job. Welcome aboard. Really glad to have you on the team.
Thank you.
Just a couple questions in the Q&A. I mean, just for tonality, I mean, is this considered an algo, if you will, or is this a platform? What would you like to categorize ATC as?
Okay, yeah. ATC is algorithmic trading training. So it's the strategies, how to use different platforms. We cover multiple platforms depending on what you want to trade, what country you live in. Like, we'll be able to cover that, where your current brokerage is. You can connect one software to that broker. So we cover all that. But there's the starting point strategies. So these are like, hey, I have absolutely no clue where to start, but I really want to do this. And I don't want to go out and start like experimenting from scratch. I will hand you stuff I built 10 years ago that has worked to this day. You will see that. And I'll show you how you can pick the stocks you want to trade it on, how to test it, how to see what the risks and drawdowns would have been and might be in the future, and how to simulate them and how to turn them on live. And all of that we're talking days and weeks, not months of learning that stuff.
Awesome. Thank you. What about the platforms? It will integrate, or it will communicate with Thinkorswim, Trade Ideas, different platforms?
Yes, there are ways to get it to Schwab, Interactive Brokers, TradeStation, Tradier. So we can send the trades to a lot of different places.
That's great. Thanks a lot. I think the rest was just based around the pricing, and I know we said we're going to get that out to people very soon. But other than that, I think this is great. It was really informative. Those have been asking about a replay. We will get that perfumed and posted very soon. But Andrew, do you have any other closing remarks before we wrap this up for you?
I just see one other question, Fidelity. I don't know if Fidelity works, but I can check on that. I do find, like, I use Thinkorswim for all my manual trading, so my discretionary manual trades. And then I run all my automated trades at TradeStation, either through third-party software or with the TradeStation software. And I kind of like that. It lets me, when I'm looking at one platform, I know what I'm doing. So even if it doesn't work to your current broker, it may be easier to open up another account, start with a small amount of capital, and just kind of use that and like incubate the whole concept of automation there. So I'd say, come into it, making it easy on yourself, which might be to open up a new broker account. Actually, you'll probably start with simulation reality. So I think that's about it. I don't see in there Stickytrades.
That's great. Thank you.
Yes. Awesome. Hey, Daryl. Okay. Very cool. All right. Glad to be here with all of you, and look forward to that announcement. And I can't wait to be in the live mentoring and helping you set up your systems.